Brilliant. So we've just got people starting to filter in. Welcome along, everyone. We'll just give it a few seconds for everyone to get in and acquaint themselves with it. Anyone who hasn't used these Zoom webinars before, if you just want to familiarise yourself, down the bottom, there's a couple of functions. There's a chat box. Feel free to pop your hellos in there and let everyone know you're here. And there are a couple of sections, so just make sure that you're writing to all panelists and attendees if you want everyone to see it. And just feel free to pop in a hello there so everyone knows who you're here. And there's also a Q&A box down the bottom as well, where you can ask questions to the panelists here, and we'll answer those as we go as well. And they can be sent anonymously, or you can put your name to it. It's completely up to you, and we'll answer them as we go along. Any ones that we don't get an answer for today, or we're not able to answer, or we don't get round to it, we'll always go away and find out the answers to those as well and come back to you as well. So if you do put your name to it, we'll always come back and try and answer where we can on those. And it's really important that everyone gets involved, really. We'll have a discussion here, and it's really an open forum between repairers and credit hire companies. We've got a really nice mixture of both who are attending today, and it's really just an open forum to discuss things on either side, and give your point of view on how you're currently seeing your industry, and maybe things you'd like to see from the other industry in credit repair, and how they can help you along the way as well. So we've got a few people still coming in, but we might as well kick off because we're past our pass now. So I'm going to kick off with yourself, Chris. This is Chris Weeks from the NBRA. Just a quick overview on the repair industry at the moment, from when we last spoke in May, and how things have changed a little bit as well.
Oh, hi, mate. Well, so, yeah, I mean, we were starting to crawl our way back to normal. You know, after sort of seeing volumes in repair shops drop to a low of, you know, perhaps 20% in parts of March and April, it really was sort of quite dire. And as we said before, if it wasn't for the, you know, coronavirus job retention scheme, I think it decimated our industry, quite frankly. But, you know, as time has gone on, we've started to see people coming back to work and started to see people getting out in their cars again as the lockdown removed. And, you know, we were starting to pick up nicely. We've got to the point now where, you know, information from the Petrol Retailers Association will say that, you know, fuel sales are up to 90% of what they were pre-COVID. And traffic congestion in some of the areas, you know, out of London, actually as high as, you know, 2019 levels. That was a report from Waze recently. So, and with the schools going back as well, which everybody was hoping for, you know, we've kind of got to about 75% of where we were previously, which was, you know, with a bit of right sizing in lots of body shop businesses, has been good enough to keep them going. But of course, you know, this annoying sort of COVID seems to be coming back, and they're pulling the rug from under us again, and the government are putting in their measures. So, you know, we're heading into the sort of a similar situation again, which is enormously disappointing. It's a really tough time for repairers. You know, they run on such a sort of a knife edge, really. They're having to make really, you know, tough decisions about, do they keep people on? You know, some have made people redundant already. Some have been left with too few people to do the work. Some have been left with too many. It's just a very difficult situation, I'd say, at the moment. I mean, I'll probably hand it around to the repairers on the table, but
yeah, no, absolutely. I think if we flip across and we'll come to yourself, Craig, Craig Bosworth from AX, and have a view on the credit hire side of things and how things are at AX as well.
Yeah, hiya folks. Seems to be getting back to normal. That's how it seems. Whether or not the announcements this week is going to change that will be interesting. Certainly, you know, from a business perspective, we've learned an awful lot during COVID. And it'd be interesting as part of this panel discussion to see how that will impact, and the learnings that we've had both in the credit hire and in the repair industry, bearing in mind that now Brexit's knocking on the door, as well as the new COVID restrictions. And are we going to see the changes and the implementations that we've done in the business being able to cope with what potentially is going to happen with Brexit delays on parts, what was it we're hearing this week, 7,000 trucks not being able to get through Dover. It's, an awful lot now is on the horizon, and you kind of go, okay, that first bit of COVID's done. We've learned a lot. As a business, we're now damn sight more flexible than we were previously with the staff. We've had the people on furlough, the majority have returned. The numbers of claims plummeted, but they're now back up to where, not quite where we would hope them to be, but they're not far off. But that was this week, and as Chris has highlighted, what's next week? How is that going to, don't work from an office again, go back to working from home? We're going to see traffic volumes plummet. And certainly especially in my specific area of the legal bit, the courts, we've gone from the issuing of proceedings and it taking 3 weeks to get the notice of issue back to that going to 7 weeks. Now it's coming back down to 3 weeks. We're seeing court cases that were originally being abandoned. In April, I think we had 3 cases go to a hearing in April, to now be back at normal levels with court hearings being remote hearings, which the court always used to kind of steer away from. And actually, is that future? We're going to see a damn sight more cases going to actual remote hearings. And the impact of what we've seen with insurers, I think, from our perspective in recoveries, insurers have not been able to cope particularly well on changing their staff to work from home. And the number of telephone calls and negotiated telephone calls, really did fall off a cliff edge because insurers didn't have that capability to answer the phones in the same way as they would in an office. So we were starting to see that recover. And there was a point there where during the first 2 months of lockdown, the recovery period started extending to beyond what we would normally hope for. That's now coming back to our average recovery period, but is that going to go back out again if insurers are not having their staff in the office when they've still not been able to cope with the changes that COVID has brought about? So yeah, it's definitely been challenging. There's definitely been opportunities. We're changing as a company. We're being more flexible. We're looking at where our offices are and indeed how many people need to be in an office, which is great for staff. They're loving it. And of course, we're trying to work with the repairer partners to make sure that we're getting the cases through and paying in accordance with what we should be doing.
Yeah, agreements. And I think that working together is the key point, because it's changing and challenging times for everyone. And as you said, obviously the Tuesday's announcement is changing all the time as well. Richard Steer from Steer Group joins us as well. Welcome, Richard.
Thank you.
And just again yourself, just a quick overview from your point of view and how you've seen it go so far.
We pretty much mirrored what has happened across the industry in respect of the journey through the sort of lockdown period and then numbers returning. We were pretty much in line with the sort of stats we were seeing centrally, drop down to about 30-35% and slowly building itself back up again. We've had obviously we were all kind of pinning our hopes on the kids going back to school, and the secondary piece that went alongside that obviously was the Nationwide demise and obviously the acquisition by Reddy. So ironically, we're now in this sort of changing landscape which we're waiting to see unfold, because obviously the actions that Reddy and Northgate are going to be taking haven't really bitten into the marketplace yet. But if you've got 77 centres and you've got the amount of repairs that they're currently deploying into a network of several hundred repairers, it doesn't take a rocket scientist to work out what's going to happen. And therefore, it's just a question of the degree and how strong that's going to cut. But obviously, equally so, we know certain insurers have obviously now moved their work away from the old Nationwide sites and have deployed that into their own existing networks and to new repairers as well. So apart from the falseness that's created by COVID, we've obviously got this secondary piece that's sat in the background that means some repairers are actually now operating at in excess of 100% of capacity because they've had some new influx of work coming in. But equally so, the flip side is a bit Peter and Paul. They've been rewarded with in one pocket and it's taken out of their pocket with Reddy moving work into their own sites. And then also is the talk about whether does the FMG work and the Northgate work move into the old Nationwide sites? Does the credit hire stuff stay out? Does that stay in a blended network? And clearly with 77 centres, they're not going to cover the whole of the UK. So a blended network will probably be where it all ends up, and the messages from Reddy Northgate are very much in line with that. So We haven't seen normal for 7 months, and I don't see us seeing normal for probably another 6 months or so, at least until we get out the other side of understanding more fully the impact of COVID and what the second wave is going to create. Looks a little bit more challenging than the first, but the difference is we've got some tools in our locker, an armory that we didn't have before, because obviously we were dealing with something that was unprecedented, and we had no experience of it. We obviously now have the opportunity with some hindsight to go, yeah, I might have done this or I might do this, and so on, adapting our businesses effectively to reflect what's required to meet the needs of our clients going forward. So, from a steer group perspective, we're in quite a good space. What's been great to see is how resilient the body repair industry actually is, and the body shop operators are. They're a very resilient bunch, and I think they've done a fantastic job in managing themselves through this crisis without fundamentally dropping the ball in a major way. It's been difficult for everybody, and I think there's some more challenges ahead of us. But I really take my hat off to my fellow repairer colleagues who have steadfastly operated and gone above and beyond, and trying to make sure SLAs are met, key to keys are satisfied, customer journey is a good one, all the good things that our clients want us to deliver. I've been really delighted from the outside looking in, and be proud to be part of that group.
Yeah, I think that reflects across both industries as well, to be fair. The adaptation that credit hire companies have made as well, in really, really tough times. Mm-hmm. To take big operations remotely has been really incredible from our members as well. So I think, yeah, definitely across both sides, and certainly how industries, they've learned to work together as well in these times as well. Cool. It's commendable across it.
Well, okay, just to add a bit to Richard's bit about the ready bit there. I totally agree with what Richard said, and just to put a bit of context around that, imagine how difficult it's been for some of those repairers going through that tough period. Dealing with furlough, making the changes into their business, all the PP and everything else, just starting to come out of it. And then, and before I sort of say anything about the Ready Group, and, you can't blame them for what they've done. I think it's a really clever move, as long as they can make it operationally work, you can't blame them at all. It's very, very smart. But to put a bit of context, we asked some of our members how they've been affected, and just out of 20 respondents, between 20 respondents, they were doing something like 770 jobs a month for the repairers that sit within that group. That's about, over £1 million, 16 million pounds worth of revenue a year, just out of 20 body shops that could be coming out now and going to what was the Nationwide group. As Richard said, insurance work that was previously in Nationwide is bouncing out already, and he's landing in body shops. But there's some winners and there's some losers, and if you're a loser to the tune of 1/20th of £1 million a month, it's enormous. So the kind of challenges body shops have got going on at the moment are just, unprecedented is the word, but it's just incredible. So I don't think we've seen the industry coming together like this ever before. It's almost like a wartime spirit out there, and a lot of people are just looking after each other and trying to help out and stuff like that. So yeah, it's a massive amount of change at the moment.
Yeah, and I think obviously you're yet to really see how that change does affect in positive or negative ways, I think, and that's quite key to point out as well. But it's still early stages on that as well, and I think it'll be interesting to see how it falls out from that as well.
Do you think that's the starting point of a new commercial model for the industry? Because when you kind of look at what they've done there, all right, like you say, there's winners and losers. There's winners and losers on any commercial deal. That's the way it works. But does that now set the scene for a new commercial model in the industry?
I'll have a little bit of a go at that. I mean, vertical integration ain't a new thing. The insurers started doing it sort of 20 years ago. And some of them failed dismally at it. There's probably two winners out there, which is the Solar Sites and Direct Line, who managed to make a real success of it. And I would say, I know a lot of people aren't in favour of that model, but at the end of the day, they have made an absolute success of it, and they make it work, which is probably why there's still growth in those areas. But they've been at it for 20 years, right? It is not easy. When you think about Nationwide, all the benefits that they had, all the purchasing power that they got, they were probably buying at better rates than anybody else in the market. Still couldn't make it. You know, making a big group operate and function profitably is super, super tough. It really is. I think Reddy might find that themselves to begin with. But, you know, just to say it's the start of a new model, I think people will be watching, see how Reddy get on first.
Yeah, absolutely. I think just coming back to other points that were made there as well, volume is obviously a huge point, and something that we're starting to get somewhere close back to normal, possibly across the industry. I don't know if you all agree on both sides that we were getting somewhere close to, say, normal, but sort of pre-COVID figures anyway, even if not quite there. But a very good point on obviously Tuesday's announcements and more restrictions coming in. Do you think that's going to have a huge effect on volume? And Richard, I'll come to you first.
Well, I think ultimately any changes and any impact in terms of people being told to go to work and then don't go to work, effectively work from home, will obviously ultimately have a driver. But you know, we can't underestimate the impact that the children going back to school has had ultimately, because you do create effectively what is almost a false rush hour. And what we saw was a rush hour was extended. Although there's a lot more traffic on the road, people were moving at different times, whereas the opening and closing of schools is pretty similar across countrywide, and therefore you will have those hotspots around there. And people, occasional drivers, by the very nature of it, are often more likely to have accidents. So, but we have this false position. It is effectively it's born out of the fact that you've got, you know, major insurers who've obviously departed the Reddy Northgate business, and obviously working with other independent repairers. So in some cases, Chris has already alluded, people are having a double win. They're keeping the old volume they got, and they're getting some new volume as well. And they might be operating, and I know people are operating back in some cases in excess of 100%. But that isn't. This is no new. There's no new work. This is just existing work, effectively moving around. It's being reshuffled and redistributed. There's no new accidents as such out there. No new volume that's coming into the marketplace. So we have this false position with a smoke screen almost around it, and we just got to wait until that smoke clears to see what actually the ongoing impact's going to be. And that will take a little while before that happens. And then when that starts to bite, and then you add the double whammy in of furlough ending, and then is it the new part-time furlough, which seems to be a bit more geared toward hospitality sector than it does industry, if I'm honest, from what the initial bit I've seen. So I think when furlough finishes, when that VAT, delayed VAT payment comes into play, end of Q1 next year, I think all of those things are going to have a significant impact on businesses. And then obviously you've got further potential vertical integration that's going to be going on. Obviously, Activate Repair have announced some big moves this week in terms of the fact they're going from the initial 5 up to 20 centres, and obviously Victoria. Turner's obviously moved across from Hastings. So there's some big things going on in the marketplace, which would be big in isolation, but they're all at exactly the same time that we're having this global pandemic. So if you took them in individual stages, nationwide going or vertical integration of different ways, and then you add in Reddy Northgate and all those things, and then other players operating in a different way. So for me, have lack of clarity, which means it's difficult then to make proper business decisions, and everything becomes a little bit short-termist in terms of how we're looking at the immediacy. And we're planning for, rather than 2 or 3 years out, we're planning for several months out at best in terms of what we're faced with now.
Yeah, absolutely. And I know sort of the hour or so before we came on, there has been a few announcements in terms of VAT payments and furlough schemes and things, which I won't go into detail with because I haven't seen it in detail myself yet. But before I throw over to yourself, Craig, just a slight bit of audience participation coming in here. So I'm just going to put a poll up, and this is related to the new restrictions that have come in, just whether you're expecting to see a downturn in volume at all through what you've seen. So Craig, I'll throw over to you whilst people have a vote on that, and then we'll reflect on how people feel.
Sorry, Matt, which bit do you want me to answer?
So
we're not going to see a downturn. In terms of downturn in volume or not from the restrictions that were put in place from Tuesday? Without wanting to influence people's vote there, yeah, I do. I do think we're going to see a downturn. But at the same time, you know, there's been a lot of discussion over that COVID period of hire lengths increasing because of lack of availability of parts, because of body shops being shut, etc., etc. And actually, you kind of go, are we going to see the same again this time? So at the moment, higher lengths are still above what they were pre-COVID. Not by massive amounts, but they're still there. And when Richard's saying that some body shops are dealing with more than 100% capacity, you kind of question, okay, if they're dealing with more than 100% capacity, is that then going to start feeding into the labour rates as they are at the moment? So are we as an industry going to start seeing a shift towards an increased labour rate to cope with the fact if I'm above 100% capacity, that means I'm paying overtime. If I'm paying overtime at time and a half, then I'm putting the hourly labour rate up. Is that something that's now knocking on the door together with the things that David Cresswell talks about on the CHO's podcast with increased cleaning charges? And are we now talking about actually there's an increase, across the whole of the economy, but you kind of go to the hairdressers now and, you've got the wearing of the masks and doing all the extra cleaning. And so the cost of having my hair cut has gone up, which some people may say I should go to a different hairdresser with the way my hair is, but there you go. And is that something that we're now going to start seeing feeding into the body shops? So the body shops come knocking on the payer's door saying, hang on a minute, £28 an hour with insurers is no good anymore. A £55 an hour walk-in rate. Now talking about something that is actually more reasonable to be able for us to cope with all of this. Is that something that I'm kind of expecting? I'm expecting the downturn in number of claims, but actually higher income revenue probably staying similar.
Yeah, I think you can see from the poll there's 85% who are saying that yes, they're expecting a downturn. And I didn't put any kind of idea of downturn on there because it's hugely speculating. It was just interesting to see. Richard made a good point about the schools going back, and obviously whilst they remain open, whether that would have an effect from how it was in the actual lockdown period from March where schools weren't open. Chris, I can see you eager at chomping at the bit on labour rate, so I'll come to you.
I'd like to say yes straight away. I mean, I think, in the credit repair world, the rates are quite heavily dictated by the AVP charge out guide, actually. Although it's not a credit repair guide necessarily, it seems to sort of be the barometer of where you can go in terms of what the man on the street ought to pay. And we very much hope it will move in that direction, because I think throughout the COVID period, it's quite easy to do the calculations. When you have a sort of downturn in volume, obviously you can't sweat your assets as much. You get some inefficiencies in there. Realistically, rates should absolutely be higher. There's no doubt about it. And the COVID rates themselves, that ranged anywhere between sort of £10 and 80 quid. Some of them did well. What I would say from the insurers actually is they did a pretty tremendous job in the end, actually, I think, of clearing up old debt, which was enormously helpful to repairers through that period. Getting old sticky invoices paid did sort of help them. But a lot of that's been done now. And if we go back to a situation where volumes aren't what they were, sort of call it, if we're saying 70, 75% now, let's say it goes down to 60, 55, just going on the back of that poll there, then something's got to happen. Something's got to compensate them to allow them to continue to provide a service for the customers. We had the benefit of the furlough scheme before, which comes to an end in October. I know they've just announced these new furlough, if you like, for SMEs that can prove that their revenues are down. And I think from what I heard, it's kind of, if you've got an employee over 33%, then the rest of it will be topped up 50% by the government, 50% by the employer, up to a capped level. But it's really way too early to understand the financial impact that's going to have on repairers that continue to try and keep as many people employed as they can and trade through it. We're going to have to do some analysis on that. We can't do it today, but again, real tough decisions. And I think any support that can be provided in terms of pragmatic increases in rates, sensible approach towards engineering using common sense, and not tying up PDAs forever and a day, around costs, I think would be enormously useful at the moment. So I think we're just about to enter into another bigger discussion about how we can operate on a more sensible basis through this to allow everybody to keep going.
Richard, is there anything you want to add at all?
Yeah, I think the couple of things really to understand about the way Body Shop works and operates is that to trade as a body shop, you need to have a critical mass of admin staff on site. So you'll need you need a manager, you need a VDA, maybe a parts guy, maybe a workshop controller, front of house, drivers and valeters. So as an absolute bare minimum, you need about 6 or 7 people doing a multitude of those jobs. They all need to be carried out to conduct a repair. But the truth is that whether you've got 5 guys on the tools or whether you've got 10 guys, you still have to have those 6 or 7 people in, irrespective. And therefore, from a critical mass perspective, if you have 50, 60, 70% of the historic volume, you've still got those 6 or 7 people in. If you're at 100%, you still have the 6 or 7 people in. So your administrative cost is as high as it was before COVID or before those new levels come into play, whereas it would be exactly the same if you had 5 productives or 10 productives. And of course, then by having 10 productives, you're increasing your output. But you obviously need to work then to keep those 10 productives busy. And this is the challenge that repairers will be finding themselves in as far as managing and understand their P&L, is that the critical cost is already there, irrespective of the volume that they have coming in the door. The rent and rates, okay, the rates, we might be getting some rates holidays at the minute, but that's going to change obviously back in March next year when the new rate structure come in, unless Rishi does something else. But he can't be on the giving out forever. And I think the repairers' challenge is going to be having enough volume in the door to bring the people back to repair the cars and get their own sales numbers up. So frankly, a movement on the rates here and there, whilst it would be very welcome, it really is about the volume of repairs you're getting in the door, because insurers, accident managers, credit are not just going to allow an uplift of £200, £300, £400 on repair costs. That's just not going to happen. So we need to get real about that. That isn't going to come into play anytime soon. So there's other ways in which we've got to be creative about it, but I think it's just that overriding costs that you have in the business to operate that will be the driver as to the issues that repairers are going to be facing. And to operate at 70% of your historic volume on an ongoing basis is not going to work, particularly when furlough finishes.
The one interesting point, and sorry, Craig, we've had a question come in, and as I said, please feel free to send your questions in and we'll answer them as best we can. The question come in is from a credit hire company, and they say they're having slight problems with repairers possibly booking too much in and taking on too much volume, possibly to get that volume that you're talking about, which is actually extending the repair length and therefore extending the hire periods. And obviously, I'm not asking you to speak for the whole industry, Richard, at all, but is that anything you've seen at all?
Yeah, I mean, well, one of the challenges you've got, of course, is it depends on where your work volumes and work streams are currently coming from. You can have the best, as has been proven, you can have the best processes, the best procurement, the top equipment, all those sorts of things. But if you haven't got volume, you haven't got a business. So you have to have a certain amount of volume. And this isn't a slow pour. You don't sort of stand there and sort of pour repair volume in. It doesn't go through the funnel any quicker. The more what happens in a funnel, like anything, is that you have a certain amount of jobs that you can complete with the bodies you've got on site. If you pour more in, it just basically goes up the funnel and then ultimately overpours. And what we saw was a step change in the business around the nationwide demise and the children and kids going back to school. That was the fundamental, and you can't balance that, because don't forget, we are reacting in this industry to whatever happens in front of us. You can't go out and sell what you're doing. Basically, what you're doing is reacting to accidents that are taking place. And the first piece of, the second week of September, when the kids have fully gone back, there was a marked change in the amount of repair volume that was available. So we immediately started bringing more people back from furlough, but it isn't, it don't happen on day one. They come back and they start repairing cars, but they were on furlough before that. So we're getting as many people back from furlough as quickly as we possibly can to make sure we can repair cars and get them back out the door. Because what is the worst thing for us singly, and to answer Jerry's question here, is that the over efficiency or the under efficiency that comes out of having too many cars on site cannot be measured. It is huge for any organization. We do not want to have cars sat on site for us. It becomes very, very economic, and you have a sweet spot around where not enough work and too much work means you do not make the money you need to operate in there. So actually having more cars just sat around on hire isn't actually any good for me either. So I would wholly move away from that. And we are working as hard as we possibly can to pull cars through the shop as quickly as possible, because sat on site is not good.
Yeah,
No.
I absolutely. And I don't think anyone doubts the hard work that's going in from everyone. Craig,
That's really interesting though, because defendants are saying effectively don't book a car in unless you've got the parts on site and you can do the job. And effectively, I think what we're experiencing, and I think what you're saying, Richard, is that's fine. I'll bring the car in when I'm at that sweet spot to bring it in. But actually, during the repair process, it might take a little bit longer because of the way that funnel's shaping, because of the fact that I might not have the right people available to do that element of the job because of where they're sitting on furlough,
Yep.
which means that the repair period might well have been pre-COVID, might well have been 6 days. But post-COVID, to do the same job might well be 10 days, but that isn't a reflection on anything other than you're trying to get that sweet spot measured with the amount of staff you've got on site.
Yeah, I mean, and that's very, very much the case, and that certainly can happen. And for some body shops, that will definitely be as is. And some are leaving people out on furlough for as long as they can, obviously, because of they have no surety of the volume of repair volume that's going to come back in. What none of us wanted to do was bring people back off furlough to only have to put them back onto the furlough scheme, because that is from a mental health perspective, managing and the welfare of our own staff, that's a really negative message to give somebody who's been sat at home for 5 months, call them back into work, and then the repair volumes drop off. 2 weeks later, you say, oh, by the way, you need to go back on the furlough scheme for another 4 or 5 weeks. That just doesn't work for anybody. So it's just that balancing act we've all got at the minute between the amount of volume we've got, the consistency of the volume, and obviously what we're faced with this second wave that's clearly very much in play. And, when the government said to me, I heard the other night, 6 months is what we're looking at potentially for this, or maybe even longer, that frightened the life out of me from a business perspective, because 6 months we were looking at 2 or 3 weeks initially. We're now looking at 6 months. And that's incredibly, and it's not just about the impact for us, it's obviously the impact on a far wider plane.
It's the classic area where, some better, as 3 industries, if you look credit hire, repair and insurance together, we don't talk a lot, to be honest. And it just shows it's that classic dynamic where we're not talking, we're all operating in silos, it doesn't work. Repairers with too little volume don't make money. If they got too much, they also struggle, but they'd probably rather have too much than too little. And then when they got too much, your hydration goes out. And then you've got the CHOs who can't make recoveries because the hydration's too long, and the insurers are arguing that it's too long and they didn't control it. And then you've got the insurers ended up with bigger bills than they should have had because the hydration's... Everyone's a loser. Exactly as Richard said, like if we could get our heads together and find a way to get some sweet spots, then, everyone's a winner, because the hire companies get paid on time. The insurers don't pay quite as much as they would with the extended hydration, but maybe pay a little bit more. And if that little bit more went to the repairers, they wouldn't be quite so keen to stock up on work. So perfect one for us to talk about at some point.
Isn't that though a big issue at the minute, where if I want more work because I don't know what the future holds.
Yeah.
So if I've got the opportunity to say, right, I've got 10 drivable jobs here, give me those 10 jobs, bring them on Tuesday, because Tuesday I've got a little bit of a movement there. I don't want to lose those 10 jobs. And is the worry that actually I say yes too often as a body shop?
Yeah, sorry.
All right.
Sorry, I missed that.
So I'm saying, is the worry that I'm saying yes too often because I don't want to lose the work? I've brought these people back from furlough, and I'm at this, everybody's back at school, nationwide has changed, and therefore for the first 2 weeks of September, I'm really busy, and I know I'm going to be really busy because they're already stacked up. But now I've got to keep saying yes, because I don't know if in 3 weeks' time, because of what's just changed, I'm going to be in a worse position, which means that the higher durations are going to consistently be at risk.
But I think, Craig, I mean, we're not talking here about a 2 or 3 week window in terms of, or month window, what we're faced with now. It's a far wider play. It's about the overall collective operating of the industry and what it's going to look like in 3 and 6 and 9 months, not where we are in terms of what we're faced with at the minute, because Reading Northgate's happened and because the kids have gone back to school. They're just circumstances that all had to have come in and been the perfect storm at one particular time. But we're looking at where we're going to be in November and in January and in next March and beyond. So there might be a spike in certain things now, but I think repairers, as I said before, no repairer wants too much work on site. I promise you that. It is not an efficient way of operating a business. Therefore, just saying yes, I'd rather say no, I can't do it, and hand over to somebody else. And I would do just put another car on site, because the cost of the inefficient operation in a body shop, we can never, ever get back. And don't forget, when a car arrives here initially, and it comes off a trailer, we don't necessarily know if that's an insurance job that's been put into us, it's a mobile job, or what the job actually is. It's a job that's turning up on site and needs to be accommodated. And there's a customer at the end of that. The customer being, in 2 cases, one is the guy that's paying the bill and the other person's the person driving the car. And that's the two-edged sword that actually comes with that. So for all our respects, I think whilst we might see some variances now, it's really caused by several things have all happened at once. And we're just trying to get on top of that at the minute, but also faced with, there are a lot of repairers, several hundred in the Ready network, who are going to lose volume. That is going to happen. And therefore you're saying, okay, what's the next stage for these repairers who don't potentially pick up the insurance work that came out of Nationwide? And we're all subject to that, all the people in that network. So it's quite worrying times underplays how important this is as a critical mass for us, because very few repairers are anything other than independent owner driver operators. That is 99.9% of the model that exists in the UK. There's no PLCs, you can't go to shareholders, it's your own pocket you're playing with. So we're all faced with exactly the same challenge, and any help that we can have and collaboration, and I really appreciate the collaboration we've had between the respective communities that have existed to keep this, because we all need each other. It's an ecosystem that all relies on each other, and that's absolutely essential going forward.
Yeah, absolutely. I think that's a very key point. And everyone does need each other, and everyone needs each other to be continuing with their work as well. So I think it is key there for everyone to work together. Question come in from the audience, Chris, that I'll come over to you with. Do you expect to see a move from repairers towards attracting retail work to create a more rounded customer portfolio? So really branching out in what they do, I guess.
Yeah, I mean, there's anyone who sort of watches Twitter will see there's a few people sort of really trying to push repairers sort of more towards the retail kind of things than the directed work from insurers. There's a lot of good work to be done. The relationships with the VMs is also really important. I think the writing's on the wall a little bit that vehicle manufacturers are going to try and control their customers a lot more, capture more of the repairs and sort of direct them directly via the VM dealerships into repairers. So I think the relationships with VMs is getting more and more important for body shops. The trouble is with consumers, and you can waste a lot of time with consumers. So I mean, it's good work, but it's very variable. And as Richard said, body shops like consistency. If you haven't got a filled up body shop, you're losing money. If you've got too much work in your body shop, you're running inefficiently, and you're not making as much money as you should. Consumer stuff is very variable, and it's very, very highly impacted by, the current economic conditions. So if people have got money, they have private work done. If they haven't got money, it just disappears. So too much reliance on that becomes quite dangerous. The one great thing about, insurance is in this country it's mandatory. You can't escape it. So by law, you have to buy car insurance, and if everyone's on the road, then you're going to have similar levels of accident frequency. So it's fairly consistent, and that's what body shops like. But at the moment, in terms of topping up things, special deals, trying to get consumers in, upsell, if the volume isn't there, I think it's a good move, and it's probably things that more and more body shops will be focusing on.
think there's a good point in the chat as well, which follows on from something Richard said. You know, at the end of the line, there is a customer there. There's a journey that they go on, and it's important to deliver the best service for them. And I think absolutely that's what everyone has in their mind to do. And that's, you know, from a credit hire and a repair perspective, it is getting that repair done and back out there. You know, no one's trying to extend it as much as possible as delivering the best service and getting the mobile on the road, which is the most important thing. Another question coming here, and I'm going to come to you, Craig, on this one. There's a question on the bottom line discounts and the late payments, which are creating additional pressure on profitability. The main thing I'm going to ask there in terms of you is the late payments. And obviously, I'm assuming, and reading between the lines, please tell me if I'm wrong here, that the suggestion is that the repairers are receiving late payments from the credit hire companies. That obviously isn't a choice necessarily from the credit hire company, Craig, is it?
No, I mean, again, I can't speak for them all. I can only speak for ourselves. And, you know, we try and work in accordance with the agreements that have been reached. You know, times are tough. We appreciate times are tough. The biggest key on the late payments is back to the fact that insurers are not paying. You know, there has definitely been a slowdown over COVID for paying historical invoices, not just COVID invoices. And the stats tell me that that's because insurers are not responding and not communicating in the same way that they would have done previously. So back to what I said at the start here, there's no telephone negotiations going on. There's nobody on the other end of a phone. What we're seeing is that we are communicating by email mostly, and there are delays in coming back by email. Then people are then becoming more email warrior-ish and sticking big arguments in that they normally wouldn't even begin to think of, which are quite clearly being driven by others. And instead of, hang on a minute, that's a nonsense argument. You know, what you're talking about, for instance, the labour rates, you know, you're charging £50 an hour, get lost, it's £28 an hour. You're like, well, no, that £28 an hour is a commercial agreement with an insurance company, not a rate that is only available to an individual off the road. That type of thing we're seeing more and more, especially when you've got the likes of the defendants' representatives at the start of COVID kicking up the big stinks over you can't do this, you can't do this, you can't do this for the repair durations. Don't do it until you get the parts in. Don't book it in until you can complete the job. And it all then becomes very, very argumentative and aggressive instead of being what it was pre-COVID, where it was a lot more pick the phone up, have a chat, explain what's going on in the case, and you're done.
Is there any scale on that, Craig? Like, so, you know, just to put a bit of context, you know, what would a recovery normally take, and how much has it moved out by? You know, would you say on average?
Percentage-wise, because otherwise I'm too commercial on AX specifically. But percentage-wise, it's moved out by about a third during COVID. And that can be, it's a big old chunk when you're talking about that type of percentage.
So that's a big chunk of cash flow that's not coming into the CHOs, you know, that makes it difficult for them to pay the repairers, I suppose. Yeah, so I mean, would you say across the industry, you know, CHOs and, you know, from talking to people that you know in the industry, you know, that has forced them to pay repairers slower outside of contracted terms, or?
That's not what I'm hearing, no, because we're too intertwined, aren't we? If I start taking the mickey out of you, then, you know, I stop getting work from that area of the business, you know, and while we're still intertwined like that, I'm still going to try my best to look after you. Just, you know, we've reached contractual terms, we'll stick with those contractual terms, and I would have thought I'm speaking for every CHC when I'm talking about that. You know, I don't want to bite the hand that feeds me. What I want to do is kind of say, you know, this is our contractual agreement. I'm going to try and pay you in accordance with that contractual agreement. You know, we've all experienced the direct accident. No, it was not direct accident. We're quoting the wrong ones. Drive assist. I knew it was a D and an A. When drive assist went bust, and, you know, there are agreements to pay somebody at body shops at 90 days, and it's only when you get to, you know, 120 and it's still not paid that you realise there's a problem. And that's the bit where you know, as a body shop, really, you've got to be thinking, am I being paid in accordance with my contract here? And of course, the pressure as a body shop is, how far do I take that if that's the type of company that's been providing me with the work in the first place? And it all becomes, you know, quite hard, quite difficult to make sure that we're all still thinking about each other here. But if one's going bust, it's how quick the other one spots it.
Yeah.
Now, I'm hopeful. I'm not hearing that there is in the credit hire industry a lot of hire companies thinking, oh my God, I'm about to go bust here. Far from it. Everybody seems to be coping. There's challenges, but everybody seems to carry on coping as they are. So, it's, as everything, it's a contractual arrangement. If somebody doesn't pay you in accordance with that contract, go and kick them.
Yeah, that's good to hear, actually.
I think that's a good point, and it's certainly a good point well made in that. Certainly from my perspective, from members I speak to, that no one's purposely not paying on time. They wouldn't do that. There's no need to do that. As you said, you have to look after your work stream, your work network. So I think there's no need for people to do that, and I don't think people are doing that where there isn't a hold up elsewhere. Rich, I don't know from a perception point of view whether that's the same for you.
Yeah. Well, I think there's a few things around that. I mean, one of the first and most important things about and going back to the piece around keeping higher duration and length, key to key times, reasonable and justifiable. Two things really with that. One is that if we extend the length of hires because we're not repairing cars quick enough, then creates a pressure into the CHO, because ultimately they are struggling to get their invoices then paid, which then creates a cash flow pressure for them, which ultimately comes back to bite the repairer on the backside, because they're the ones ultimately not going to get paid because the CHO might have gone bust or out of business in the process. So actually, that's a false economy for us, because ultimately it creates an obvious pressure for us. The second thing is around that is that there is no material benefit. If I've agreed an estimate at £2,000, and that's what I'm going to get paid to do that job, if it takes me a month to do that, I'm still only going to get £2,000. There is no material benefit in it for me to extend the length of that hire. And a car sat on site for me for a month is actually bad news. I cannot make money taking a month to repair a car. So I want to get that car in and out and off site and get my invoice raised and paid. There is no upside for the repairer for extending the length of hire. So why would I not do that? I'd not do that because there's no benefit for me. The other thing as well is that when that job goes back to the client who's driving the vehicle, they go, oh, you took a month to repair my car. I'm going to go on Google or one of the other websites and give you a really bad review. It doesn't say the credit hire organisation XYZ. It says the repairer took forever to repair my car. And in this world of more user chooser and more visibility around repair and CSI, it isn't in my interest to get bad CSI, because that has a natural knock-on impact on my fault work as well as my non-fault work. So in every respect, my job is to get the cars in, repaired and out the door and not delay any of that process. That's an upside for the CHO, that's an upside for the insurer, and everybody ultimately keeps the system all moving and operating the way it actually should do. So from our perspective, all of those things point to us having a common goal and a common aim. And therefore, from me, and certainly the way I operate my business, and I know a lot of my repairer colleagues are exactly the same, our focus is around delivering the right customer satisfaction, the right journey, and the right repair quality for those repairs, justifiable based on the vehicle that's turned up in the first place with the accident damage. And that's really where our focus has got to be. As far as late payments and so on, and our debt, we saw a massive spike. Ours grew 80% in the first 7 weeks. 80% in the first 7 weeks after lockdown, and then we suddenly obviously got all over it when obviously people started to settle down and got access to their account systems. We knew how to contact, email central, off we went, and we managed to get that back down to a more manageable level. So from our perspective, if I signed a contract that says I get paid in 60 days, 90 days, 30 days, all I expect is someone to meet that. I'll do the work for you. I'll give you the right quality and right customer experience, customer journey, but you just pay me on time. And in the main, our clients have been excellent with that, and I've got no challenge with that at all. And Chris alluded to earlier, a lot of people have worked really hard to try and reduce a lot of that old debt. So, and for that, I really appreciate it, because cash is king right now for everybody.
Yeah, absolutely. I mean, cash is king, and that's absolutely the point as well of paying on time. Is it relies on the credit hire company getting paid on time as well. Lead that down, because cash absolutely is king, and there's not reserves necessarily out there to advance payments and to help out in that sense. Chris, anything to add?
Yeah, no, I mean, I agree with you know, what Richard's saying there. You know, there's no benefit to them to keep up cars around. You know, credit hire companies make money out of the hire, but they do also make money out of the repair. And, you know, getting that balance right, and the insurer pays for it one way or another, but I think getting that balance right could benefit everyone. You know, as Richard said, there's no point having that car. You know, if they were to pay a little bit more, you know, there's some cars that go through that then they haven't got a hire on them. So it's not so stressful in terms of, you know, how quickly they get done. I think we could talk more. Like, I don't think there's been enough imagination in that space.
No.
So you've got those dynamics, and we've also got the recovery dynamic, which is the bottom line discount, you know, that can be 20, 25%, as high as that. Repairers don't get parts discount, you know, they just don't get that. So they're often losing money on parts. It just seems to me that if we could get around the table with some really clever thinkers, there might be some better subrogation approaches that, you know, doesn't turn credit repair into a risk game for repairers where, you know, some they win. On the whole, they win, to be fair, you know, but if you don't do loads of it, repairers can get hit hard. And then you've got this whole starting up thing again. So where, you know, we didn't have a lot of work going through the COVID period, and we still had that tail of credit repair, you know, income coming in, sort of 60-day stuff. That was fantastic through that period. But now we're getting that situation where that work is coming through again for repairers, but they're not getting that old money coming through. So they're eating into their cash reserves in order to process credit repair and stuff like that. And, you know, that will catch a few repairers out, I'm sure. You know, they'll be spending a lot of money, you know, 10 grand's worth of parts, and it's not going to come in for a while. I mean, Richard, I don't know, is that something you're conscious of?
With the bottom line discount piece and the lack of well, I mean, you know, at the end of the day, we've all seen the move, and Chris, you and I were actively involved with it because we went to one of the vehicle manufacturers to understand why they'd arrived at this particular model, and I could tell you the calculations that we did at the time felt we were going to lose 7% of our terms, which is actually a 25% reduction in the discounts that we received, and as more of the OEs have moved to this newer model, you know, we've seen GM with PSA and so on moving to that model. Ford have obviously gone that way. TPS already were there. Others looking at it as well. The discounts only go one way. No one's terms improving. They only go backwards. And we genuinely, in too many instances, are sticking notes to the outsides of panels that we're fitting on vehicles, because we are making nothing, and I mean nothing, out of those. And in some cases, we're actually losing money on fitting parts, which as a model is just broken. I mean, it's got to be addressed. Now, I know we signed up to those contracts, but ultimately the vehicle manufacturers are exercising their position that says that they can reduce the discounts that we're receiving. And because it's a centrally controlled model, there's no competition. They've removed all competition in the marketplace. Before, you could have traded one dealer against another for SLAs and for discounts and credit terms. That's now gone. We pay centrally in one place. The terms are determined. The site that we have to deal with is determined. We've lost all choice within that model. And I would implore the CHOs to look at that particular area, because the bottom line discount pressure, when you look at parts, is huge, and it is an ongoing pressure that's not going to go away. So that will be something that would greatly assist us from a working model perspective.
I think just to go back on the cash point as well, just there's been a question in terms of could work providers support their repair partners by paying recovery costs up front to support the body shop's cash flow. I think, Craig, I'll just come to you in terms of cash flow, and again, that the flow of it from where that's coming from, the source as well, just a little bit of how that restricts the possibilities to do that.
I mean, it's massive. And, you know, Chris, you say you get a lot of intelligent people around the table and you can come up with some ideas. It's dead simple, isn't it? You just say to an insurance company, here's the repairs, here's the anticipated repairs, I'm going to start the job today, pay me. That's it.
Yeah. No, well, and no. I mean, you know, I think getting the money up front, that's a really important point. But, you know, the other point that Richard made about the parts discounts, you know, I mean, for anybody out there in sort of credit hire company world, you know, that isn't aware of it, you know, we are literally facing a crisis. Okay, so, you know, the margins that body shops were making on parts are just evaporating. You know, TPS has already happened, Ford's already happened, Vauxhall PSA is in the process of happening now, you know, with significant amounts of discount disappearing. Look, just put it in context, right? So let's say a job came in, it was £5,000 worth of parts. Let's say we were only getting 7% discount, right? So, you know, the repairer's getting 350 quid off of that. If they have to give away 25%, bottom line, that's 1,250 quid. They're losing 900 quid on parts, right? Boom, gone. So yes, the labour rates are good, but you know, this is something we need to really talk about. We really need to get our heads around and get creative, innovative around this to try and deal with what the manufacturers are doing with the discounts that they've been provided to repairers. That, you know, I'd say it's a crisis, and it's something we need to get around the table and have a good think about.
I think
very difficult that though, isn't it? Because to draw a comparison, what it costs me to get a vehicle in for, and what I can charge it out for, and you know, you can control the labour. That's your cost. You're actually spending that's your bit. The parts you can't control. So
Agreed.
you know, if somebody's saying to you, you know, the parts are £1,000, the parts are £1,000. If you get a discount on that you're prepared to then pass on in some form or other as part of your contract that you've agreed with your work provider, whether it be a CHC or the insurer or whoever it is, and that changes, then you've got to go and, you know, from a lawyer's point of view, you've got to go and renegotiate your deal. Because I can't, it's an awareness point, thank you very much for making me aware of it, but I can't deal with that. I can't deal with that for you as a credit hire company. All I can do is say to you, okay, tell me what you think the contract should be. If you think the contract's wrong, then tell me why the contract's wrong. But if you're saying that actually, you know, as a company, you've got that control.
We get this from insurers as well. You know, the contracts don't get renegotiated, and they just say, "Well, come at us then. Tell us what you need." And so maybe that's the answer. You know, maybe we need to just come back and start saying, "Well, look, you know, we love working with you, but we're going to need to go into some renegotiation."
I think that's all you're left with.
Yeah, yeah, fair point.
And I think Craig's also spot on in terms of an awareness piece there, and you know, those who are on the webinar now, an awareness piece that it may be a conversation that repairs want to have. It may be a conversation credit hire companies want to have or don't want to have. Obviously, that's very much up to individual businesses to discuss and to come to there. I'm very conscious we're coming up to the hour now, and that's still quite a big point to discuss as well. So I think if we leave it on there as well, if anyone has got any further questions, feel free to pop them through as well, and we'll pick up any there that haven't been answered as well and get them through. But from me, thank you very much everyone for joining. And we have got other webinars coming up as well, so if you check out the CHO website under the events page and just see what else we've got coming up as well. If you've enjoyed today, and as always, any feedback's welcome as well. So thank you very much for joining everyone.
Thanks, Matt.
Thanks folks, have a good afternoon.
Cheers all.